Here's the problem. With a traditional 401k or IRA, you have tax deferral at the time of deposit. You have tax deferral on growth, but you must pay state and federal income tax at the time of withdrawal. A Congressional Budget Office report from May 2008 concluded if Social Security, Medicare, and Medicaid go unchanged, the lowest tax bracket would have to be increased from 10% to 25%. The 25% tax bracket would have to be increased to 63%, and the 35% tax bracket would have to be increased to 88%. With a Roth IRA or 401k, you don't pay taxes in the future at the time of withdrawal when they're likely to be much higher, but you do pay taxes now at the time of deposit, losing your current tax deduction. And neither plan provides the highly sought-after benefits of a traditional pension plan like guaranteed growth or a lifetime income. So what's the answer? A strategy that gives you tax-deferred deposits now, tax-deferred growth, tax-free income in retirement, guaranteed protection of principal, locked-in gains on growth, and lifetime income guaranteed to never decrease. Let's explore how this is possible. First, you need to understand, if tax rates stay the same, your net spendable income with a Roth IRA and a traditional IRA is exactly the same. The only way you benefit from a Roth is if taxes increase. For a detailed explanation, watch the video entitled 401k IRA Myth Number 2. Deferring taxes will give you more income during retirement. In today's environment, most believe income taxes will increase, and this is the reason for the dramatic increase in Roth conversions. However, if you had a strategy with tax-deferred deposits, tax-deferred growth, and tax-free income, and you're in a 25% federal tax bracket with a 6% state tax, you would automatically have 31% more spendable income. To do this, we start with a traditional IRA and design it with a goal of providing an income during retirement no higher than standard deductions and personal exemptions. For a married couple retiring today, that would be $18,700. For many, the first thought that just popped into your head was, what if I need more than $18,700 in yearly income? That will be addressed in a second strategy, but first, let's finish this one. Because standard deductions and personal exemptions are indexed for inflation, if we were looking at a 55-year-old who was planning to retire 15 years from now with a 3% inflation rate, we could design a plan with a goal of withdrawing $29,000 a year during retirement and still pay zero state and federal income tax. Because we are automatically producing a 31% higher spendable income, we can now look at an accumulation vehicle that fills in the gaps currently missing with an IRA or 401k. Things like guaranteeing to never lose a penny of your principal, locked-in gains every year the market is up, guaranteed growth or market gains, whichever is higher, for up to 20 years before retirement, lifetime income guaranteed to never decrease even if you run out of money in your account, and all fund balances inheritable by your loved ones. All features found with a fixed indexed annuity. When you talk about putting a fixed indexed annuity inside an IRA, the first thing the so-called experts say is, that's ridiculous, because you're duplicating the same features of tax deferral. This is true, however, you can't get tax-deferred deposits with a fixed indexed annuity outside an IRA. And a traditional IRA doesn't give you the pension-like benefits of a fixed indexed annuity. So by putting the fixed indexed annuity inside the IRA, we have the best of all worlds. And using our standard deductions and exemption strategy, you would have zero taxable income with either. Your real risk with this strategy is the stock market will go gangbusters, outperforming the fixed indexed annuity, and/or the government greatly reduces or eliminates standard deductions and personal exemptions. If the market goes gangbusters, there is no reason for the government to reduce or eliminate standard deductions. And with the 31% in increased spendable income, you're likely to still be ahead of the game. If the markets do poorly and the government eliminates standard deductions, you're likely to be ahead of the game because of the guarantees with a fixed indexed annuity over poor market performance. And you can also roll into a Roth IRA at any time. The more likely scenario is that the markets will continue to trade in a range like the last 14 years, allowing you to benefit from guaranteed protection of principal and locked-in gains, and standard deductions will stay in effect with increased taxes on higher earners. Some of you may have already converted everything to a Roth and are now asking yourself if you have lost the opportunity to use this strategy. Any Roth conversion can be recharacterized or undone anytime up until the next tax filing. So ask yourself this: does it make sense for me to risk losing spendable income because of increased taxes with a traditional IRA, or lose tax deferral with a Roth IRA? Or does it make sense to establish a strategy to provide me with 0% tax bracket, plus all the safety features of a traditional pension plan in the form of a fixed indexed annuity?